Most investors obsess over one thing: returns. Which stock will grow faster? Which fund beat the market? What was last year's performance? But there's a silent force working in the background, one that can quietly reduce your gains year after year: taxes. Two investors can earn the same market return and end up with very different results, simply because of how taxes were handled. In this video, we're breaking down how taxes quietly eat into investment returns, the most common tax mistakes investors make, and practical strategies to help you keep more of what you earn. No jargon, no scare tactics, just a helpful guide to smarter investing. Why taxes matter more than you think. Let's start with a simple truth. Your real return is what you keep after taxes, not what your portfolio earns. Imagine you earn a 7% annual return. Sounds great, right? But if you lose 1 to 2% of that every year to taxes, suddenly your long-term growth looks very different. Over 30 years, a 7% return becomes life-changing wealth. A 5% after-tax return can mean hundreds of thousands less. Taxes don't always feel painful because they're often automatic, spread out, or triggered quietly in the background. But compounding works against you when taxes are involved. The main types of investment taxes. Let's quickly cover the big three investment taxes most investors deal with. 1. Capital gains tax. This happens when you sell an investment for more than you paid. Short-term gains held under a year, taxed like regular income. Long-term gains held over a year, usually taxed at lower rates. The key idea? How long you hold matters. 2. Dividend taxes. Dividends feel like free money, but they're often taxable, even if you reinvest them. Qualified dividends usually get lower tax rates. Non-qualified dividends are taxed as income. 3. Interest income. Interest from bonds, savings accounts, or money markets is typically taxed at your full income tax rate. This surprises a lot of conservative investors who think safe also means tax-friendly. How taxes quietly reduce returns. Here's where things get sneaky. Taxes don't just hurt once, they interrupt compounding. Every dollar paid in taxes is a dollar that can't be reinvested, can't compound, can't grow over time. This is why two investors can own similar assets, earn similar returns, and still end up very far apart financially. Frequent trading, high turnover funds, and unnecessary sales all create tax drag, a silent leak in your portfolio. You don't see it on a daily basis, but long-term, it matters more than many fees. Common tax mistakes investors make. Let's talk about a few common mistakes that cost investors money. Mistake number 1, ignoring asset location. Not all investments belong in the same type of account. Putting high-tax investments in taxable accounts can be costly. Mistake trading too often. Every sale can trigger a tax bill, even if your money stays invested. More activity doesn't mean better results. Mistake number 3, chasing distributions. Some investors chase funds with big dividends without realizing those payouts may be heavily taxed. Mistake number 4, forgetting about after-tax returns. A 6% return after tax can be better than an 8% return before tax. Always think in after-tax terms. Smart, tax-aware investing strategies. Now for the good news. There are ways to invest more tax efficiently. 1. Use tax-advantaged accounts. Accounts like retirement accounts, tax-deferred or tax-free accounts. These protect your investments from yearly taxes and allow compounding to work uninterrupted. 2. Match investments to account types. A simple rule of thumb: tax-inefficient investments, tax-advantaged accounts. Tax-efficient investments, taxable accounts. This is called asset location, and it can quietly add thousands over time. 3. Hold investments longer. Long-term investing doesn't just reduce stress, it often reduces taxes. Lower tax rates plus fewer taxable events, better results. 4. Be strategic when selling. Sometimes timing a sale, waiting for long-term status, or offsetting gains with losses can significantly lower your tax bill. 5. Think holistically. Taxes shouldn't drive every decision, but ignoring them is a mistake. Smart investors consider risk, goals, time horizon, and taxes. Taxes may not be exciting. They don't trend on social media. And they rarely get the spotlight. But over decades, they play a huge role in your investment success. You don't need aggressive strategies or complicated tricks, just awareness and a thoughtful approach. If this video helped you think differently about investing, hit the like button, subscribe for more practical investing content, and share this with someone who's focused on returns, but maybe not taxes. Because in investing, it's not just what you earn, it's what you keep.